Welcome to Lecture 4 in the Accounting Lecture Series. In this lecture, we will develop an income statement for Week 2. This lecture is based on the book The Accounting Game, written by Darrell Mullis and Judith Orloff. Let's try to build another income statement. You can print an empty income statement that looks like this by going to Google Drive and looking for the income statement document. I strongly recommend you try to build it yourself before moving on, so you can discover where you struggle. You can use the next slide, which has an overview of everything that happened in Week 2, to try to fill the blanks of the income statement template. Here is an overview of everything that happened in Week 2. Let's go over these items one by one and see whether they are relevant to the income statement and how they affect the income statement. The first item is that your ending inventory of last week was $2. How does your ending inventory of $2 of last week affect your income statement for this week? It is now your beginning inventory. So we add $2 in the blank next to beginning inventory. You also went to the bank and managed to get a $50 loan. How does this $50 loan affect the income statement? Please pause the video lecture and try to answer the question for yourself. The loan itself does not affect the income statement, because it is not something you earned through sales. It is also not considered an expense of doing business. The next item is the sale of your old inventory for $2. It also cost you $2 to make that inventory. We will put $2 in sales to reflect selling the $2 in lemonade. As of now, your gross profit for Week 2 is 0, because you sold the inventory at a price that only allowed you to cover the cost of goods sold. You then went to the store and bought 10 pounds of sugar for $4 on account and 100 lemons for $20 in cash. How does the purchase of sugar for $4 on account and lemons for $20 in cash affect the income statement? Pause the video and try to decide which changes you should make to the income statement. The purchase of sugar for $4 on account and lemons for $20 in cash should all go under purchases. Whether or not you paid in cash does not matter for the income statement. What matters is that you acquired the lemons and the sugar. When you actually pay for them is irrelevant. The $24 in purchases brings the total available for sale this week to $26, $2 of which you sold earlier on. Your sister charged you $1 for labor to make the lemonade. How does it affect the income statement? Please pause the video lecture to figure out how the $1 labor charge affects the income statement. The $1 labor charge gets added under inventory because it is a cost related to manufacturing your goods. The value of the labor is tied up into the finished goods, the batch of lemonade that your sister made, and it should not be expensed until we sell that batch of lemonade. This brings the value of total available for sale up to $27. You next went out to sell lemonade. You sold the entire batch of 60 glasses. You received $20 in cash and $10 in accounts receivable. How does the sale of 60 glasses, for which you received $20 in cash and $10 in accounts receivable, affect your income statement? Please pause the lecture video and try to answer this yourself. You sold 60 glasses for which customers paid $30. Whether or not they paid in cash is irrelevant. The only thing that matters is whether or not the sale occurred. This brings the ending inventory down to $12. We sold our $2 in lemonade that we made last week, as well as our entire fresh batch of lemonade, which cost us $12 in ingredients and $1 in labor to make. Therefore, our cost of goods sold was $2 plus $12 plus $1, which equals $15. This brings our gross profit to $32 in sales minus $15 in cost of goods sold, which equals $17. You then faced a bad debt expense of $4 because your friend who drank 8 glasses but did not pay cash moved away. The bad debt expense is considered an expense of doing business, but it is not related to manufacturing the lemonade, so it goes under expenses. You then repaid the bank half of the loan, and the banker told you that you had to pay $2 in interest. The cost of paying the loan principal is not reflected on the income statement. It is not an expense. It was something that was given to you to use, and now that you no longer need it, you simply returned it. the net effect was zero. The interest expense, on the other hand, affects our income statement. But the interest cost is not related to manufacturing your lemonade, so it goes under expenses and not under cost of goods sold. Finally, you paid $3 for a 3-year liability insurance. How will this affect the income statement? The need to have the insurance is a consequence of doing business, so it's definitely a business expense. But should we expense all $3? It wouldn't give us an accurate picture of the business if we expensed all $3 now, because it would misrepresent your net profits for this accounting period by decreasing them with the total cost of the insurance. Therefore, we will only expense the first year of the insurance right now. The second $1 will be expensed in your second year, and the final $1 will be expensed in the third year of operation. This finalizes our income statement. We had earlier calculated a gross profit of $17. When we take into account your expenses of $7, which include the bad debt expense, interest, and insurance, this leaves you with a net profit of $10 for week 2. When we compare our balance sheet and our income statement for week 2, we can see that our earnings week to date of $10 equal our net profit in the income statement. We also had $12 in inventory under assets left on our balance sheet, just like our ending inventory on the income statement. Do you know which method of accounting we have been using? It's called the accrual method. Do you know what the accrual method means? It means that we account for everything as it happens, as it accrues. The advantage of using the accrual method is that it creates an accurate measure of the company's financial position, independent of whether or not the cash has settled. This method became prominent when people stopped paying cash for everything. It is important to understand that the accrual method is not always consistent with when one pays a bill or receives cash. Can you think of any examples that illustrate this? We considered it a sale when your customers purchased a glass of lemonade on account. We counted goods under inventory even when you purchased those goods on credit. We have expensed your insurance in the year you use it, even though you paid for 3 years in advance. The accrual method recognizes money as it is earned, not as it is received. Accounts for purchases when they happen or when we owe them, not when we pay for them. Accounts for the insurance as it happens or as we use it. Which of these answers do you think accurately reflects the accrual accounting method? Please pause the lecture video to think about this. None of these reflect the accrual method. They reflect whether cash went in or out instead.